What's up, outliers? We're starting a little spicy. So I made a post yesterday on good old R Options subreddit, my old stomping grounds. And this is the kind of post that as I was making it, I knew that it was going to ruffle some feathers. You get a pretty good sense of the kind of things that people are, when I say people, I mean the masses, are more or less receptive to hearing. The problem with a post like this, in terms of why people tend to feel some type of way about it, is because you cannot read this post and find at least 5 to 10, if not more, items that apply to you. And that's a little frustrating because then you have somebody that's on the internet essentially saying, if any of these signs apply to you, then you might be gambling. That starts to attack directly what you're doing, and you will get defensive responses. Fully anticipated that. Now, the reason why I made this post is last night I was working on something else, and I was talking with a couple people about the prospects of trading and how many things you need to do properly in order to be successful long term. This requires a pretty detailed self-analysis of how you think about things, how you behave, how you perform. And unlike other skills or other professions, there isn't a guidebook that we know works for retail traders. Kind of the trick about it. For example, I know that if I go to a decent med school, I get my degree in whatever it is that I need to get my degree in, I go do my residency, and I follow that standard training path, there's a pretty good chance that I will find my way into being a doctor that can perform at least basic functions until you choose to specialize, get better at your job. There is none of that for trading. There is no path for you to follow. There is no framework that's given to you. It is entirely up to you to navigate this on your own and to determine what works well for you and what doesn't. Part of navigating this whole thing is identifying all of these different traps that exist. So in that conversation, I was literally self-reflecting all different types of bad habits that I have personally had over my trading career. It was designed to be, I didn't have a number in mind, but I was expecting it to land somewhere around like 15, maybe 20. And then I just kept realizing, like, as I would write one down, another one would pop in my brain, and I just kept going until I just found a spot where I was like, okay, this is enough. I want to review this post with you all because I think that there is a lot that you can pull from this. Now, unlike most of the people on Reddit, and again, rightfully so, the idea here isn't pontificating from the lens of, if you do any of these, I say you're gambling. Not at all. You can even do many of these and not be gambling at all. That's why it's also phrased very carefully in terms of might. Because what I do know is that if you do any number of these, while you might not be gambling, if you are gambling, you are doing these inherently. So what I'm identifying there is these exist if you are gambling, they potentially exist if you are not. That's the default starting point for this kind of thing. The goal for this is self-awareness. That's it. That's literally it. Because there is a very steep learning curve to trading, and the reality exists where you don't know what you don't know. And there likely are going to be some pieces of this that might not even make sense to you. And I encourage you to ask if they don't, so that we can talk about it. And I can give you examples to help try and make it a little bit more clear. All of these exist on a spectrum, and there's a few different ways to think about whatever affliction you have out of this list. None of this is WebMD death sentence. If you have these, you fail. Not at all. But it's something to draw attention to. The main reason for this post, my main hope, is that a certain number of people will read it and they will say to themselves, oh shit, I didn't know that's a bad habit potentially. Let me explore that a little bit more. That's the specific use case. So that's the use case I want you to keep in mind as we go through these. I specifically want you to hone in on yourself. If you think of some of these, probably a lot of them, you will say to yourself, yeah, I kind of know this about myself. That's fine. It's more interesting and more useful if you see something in here that you then identify, you exhibit to some degree. That is now you learning a brand new data point in a new way about yourself. Then you can decide whether or not it's relevant, you think it's a problem, it's not a problem. That's open for interpretation. But the first starting point there is awareness, even knowing that it's a thing. So let's jump into this list of highly random 47 things. And this is kind of like in no logical order, kind of built it, again, just following train of thought. I'll zoom in a little bit, make this a little easier for you all to follow along. Okay. The very first one is you find yourself happy after winning or sad after losing. The funny thing is, this is probably one of the most debated parts of this post. If you go through the comments, it's quite entertaining. A lot of people are like, it's impossible to not be happy or sad after winning or losing. And it's so funny to me because this is a scenario where somebody is so used to their way of thinking that they can't even conceive of an alternate world where this isn't the case. I can tell you from my own experience, this is not the case as you become more professional. The reason, and that's again, I wouldn't take any of this stuff like hyper literally. It doesn't mean that in terms of if you were to attach some sort of meter to your emotional level, that if you win, you don't see a little spike, and if you lose, you don't see a little dip, right? Like, of course, there's going to be some level of something somewhere. But the main point here is if you find yourself in general after a winning trade and you're happy, or a losing trade and you're sad, that is a prime example of gambling. Think if you are gambling, if you've ever gambled, if you buy a lottery ticket, you scratch it, you won. What's the sensation? Happy. What's the sensation if you lose? Fuck, I lost. That sucks. Let me go buy another one. That's exactly what it is. The problem here is people very oftenly focus too much on individual outcomes versus the process. The reason why I don't get elated after I have a winning trade is because I know for a fact that's not my last trade. I know for a fact that there's going to be losing trades in my future. And I also know for a fact that if I allow myself to experience the highs of winning and allowing that emotional reaction to occur, I also am setting myself up for the lows when I subsequently and inevitably have losing positions. The way that I train myself is whether or not a trade is profitable, I don't really care. Genuinely, I really don't care. Obviously, I prefer them to be profitable, but I'm only trading strategies that I know make money over time. The example for this is if I gave you a specific series of lottery tickets that if you go to the gas station, You buy 5 of this lottery ticket, 6 of this other one. You buy these configuration of lottery tickets. And if I guaranteed you every single time you do this, you might not make a ton of money, but you're going to make something, would you follow that plan? And most of us would. I certainly would. If I knew there was some configuration of purchasing lottery tickets and I would make a certain amount of money each time I do it, no matter what, I would do that. What that means is, think of that scenario. Think of that scenario. When you scratch off a losing lottery ticket, does it make you sad? No. Because in this scenario, you know you're going to make money once you finish scratching all your tickets. So the losing ticket impacts you not at all, because you know that once I finish scratching all of these, I'm going to have something profitable. That's what happens in trading. You get to a point where you know the thing that you're doing is going to work. So exactly as Joe just pointed out, there is no more hope. You know what's going to happen. You don't know exactly how it's going to happen. Might look a little different. The metrics might look a little different, but you have a pretty damn good understanding of what's going to happen. This is a big turning point for a lot of people, and it's very difficult because most of us start trading with the idea of trying to change our lot in life. Most people start trading that don't have a lot of money, that are trying to make money and change where they are. And I understand that full well. That's where I started. Unfortunately, that's not how this thing works. Trading genuinely is a marathon. It's something that lasts a long time, hopefully. Hopefully you live a long, healthy life that you can continue to trade, do well. That's the target. The next one is a dovetail off of this. And it's the same exact general theory. The fact that if I put on a trade, do I want it to be profitable? Would that be my preference? Yes, that would be my preference. In reality, I know I don't get to pick. That's not my choice. It's completely outside of my control, which way the thing goes once I enter. I have no say in that. What ends up happening is you shift your focus from whether or not an individual trade is profitable, and you simply focus on the application of your strategy or your system. And you say, these are the bounds that I need to stay within. This is the sequence of lottery tickets that I have to buy in order for this thing to net out positively expectant. The same thing here. It's just in a trading context. You say things like, I need to let my winners run more. The reason why I highlight this is because this kind of statement is not based on anything. People will say stuff like this and it's completely fucking random. They will have 3 trades that lose in a row and they'll say, oh man, I got to cut these losers quicker. The losers are killing me here. Again, there's no focus on a process or a system. It's again still this myopic focus on individual trade outcomes, which I will always reiterate and remind you, it's the wrong place to look. You already know what this one is. The frequency that people will hear somebody do something somewhere and then blindly apply it to what they're doing, thinking that it's the right thing to do. The first thing that comes into my mind here, as usual, is Tasty Trade. It's not bashing Tasty Trade. It's because Tasty Trade's approach is built around effectively a really small universe of profit mechanisms that are just traded different ways. So when they're publishing their research about their strategies, people will then take that and say things like, oh, 50% credit received is optimal. And it's like, it's not. It's highly, highly, highly subjective to what the individual thing is that you're doing. It's not just 50% is optimal. Done. There's more detail than that. Does that mean that 50% wouldn't work in your instance? Maybe. Maybe it would, maybe it wouldn't. I don't know. Depends on the circumstance. But what I do know is that it's not optimal in all circumstances. Does that mean that you can't use it because it's not optimal? Of course not. if you have something that works well enough and you're comfortable with the performance and what it's doing, you don't have to overcomplicate it if it's doing what you want. But I wouldn't confuse that with optimal. Those are two different things. One of those is convenience-based. The other one is what's actually optimal and what performs well. Why do I make this distinction? Because I've already showed you many of times with the compound growth calculator that this makes a pretty significant difference. This concept of optimal versus suboptimal makes a profound difference depending on the time frame that you're looking. If we have a $50,000 account, you save $1,000 over 20 years. We start with a 10% return. If we do 1% better over that time frame, that takes you from about $1 million to 1.1. Not that exciting, right? It's kind of like whatever. This relationship gets blown out once you begin compounding past 1 million. Say, for example, we save a little bit more. We give ourselves a little bit more of a runway, and we're talking a slightly higher return profile. This now becomes a massive difference. So, for example, over this new scenario, you go from 11 million to 13.8 million. That's a significant sum of money for just a 1% variance in your performance. This is why I do personally care about at least acknowledging and understanding what's optimal. Because again, this stems from people's inability to look at the long run and the frequency for people to overemphasize their near-term preference. Near-term preference being, I don't want to do something that's super difficult. I don't want to spend a bunch of time doing this. I don't want to read a bunch of papers. I don't want to do this, that, and the other thing. It means I can't go golf or whatever else is that you want to do, which is cool. You can have whatever priorities you want. There's an opportunity cost to those. And again, we should at least acknowledge it. A great example of this is, I use myself as an example because it's a pertinent one. I am at a really fortunate spot in my life now at 34. Most of my friends are still struggling to even get into their first house. Meanwhile, I am in not my first house, and it's over a 7-figure house. It's completely different. And a lot of that is because in my early and mid 20s, I focused elsewhere compared to a lot of my friends. And that's not saying one is better than the other. A lot of them had really, really cool experiences in their mid 20s. I did my best to find a balance where I wasn't like doing nothing, but I definitely leaned way more heavily on playing a slightly deeper game. The cool part is, if you do that earlier and aggressively enough, the deeper game becomes shallower, gets to you faster. That's the cool part. Okay. Ben Holio, that's a hilarious name, says Tasty is based on teaching viewers to make Tasty the most money in trade commissions. I hear the criticism and I don't blame the criticism. I genuinely do not think that that was Tom's intention, but I do think without a doubt, the Tasty approach certainly does generate higher commissions. If we took that to an extreme though, what would make them even more commissions? Certainly not moving options and opening positions that are 45 days out and managing them at 20. Definitely not that. They would make way more money if they're like, well, it's optimal to open these at 5 days and manage them at 3, right? That's 2 days in a trade. Think of how many cycles you can get out of that in positions. I understand the comment, and I definitely agree with elements of it, but I do think it's important, again, to like look at it objectively. and give credit where credit is due. And they definitely did not optimize for making as much money as they can on commissions, for sure. They did not do that. They could have if they wanted to like run a genuinely dishonest business, which is not what I think they do. But yeah, it's a fair point nonetheless. And I think it's something that people should be very thoughtful about is how much does it cost you to transact? Because a lot of people don't think about that. You place a trade without knowing where you're going to manage it, both profit and loss. That's easy. That's self-explanatory. This is the same thing if I play roulette. I play roulette. I put my money on black. That's it. There is no management. I have no management plan whatsoever. At that point, it is Jesus take the wheel and hopefully it lands on black and I make a little bit of money. That's it. If you do that in trading, where you place a position and you find yourself saying things like, how should I manage this? My strike was breached, or this other thing happened that I didn't consider. What should I do? There's an element of gambling there. Now, again, everything in here can't be taken too literally because there will always be instances that occur that you can't always fully plan for, but you can still plan the management of the trade. A great example of this is during a global fucking pandemic like COVID. That was not in my playbook. I did not have anywhere in my trading plan for trading global pandemics. Wasn't on my list. But every single trade that I had out when that was going on still had a plan in place. Even though I had not considered global pandemic as a specific scenario, every single position I had on still had P&L management metrics associated with it. That's something you can control quite literally every single time without fail, period, full stop. No reason not to. The only reason people don't do this is because they're lazy. They don't want to actually consider what they're going to do because then you have to think through different scenarios. It is work. Even the game of figuring out what kind of profit taking you want to do, that's not easy because like some people will say, I need to let my winners run more, or I need to try and have a higher win rate or whatever it is. That's cool. All of that stuff is fine. But you have to think through it ahead of time. It's not something that can be done at point of, which is challenging for people because it forces you to think in a way that's a little bit uncomfortable, especially when you have to consider the failing side of your trade. What are you going to do when it doesn't work? The process of acknowledging the fact that it doesn't work is tricky for some people right out of the gate. This one is super common, which is you try a strategy for 3 days, 2 weeks, whatever, and you jump to something else because you think something else is working better or because you saw somebody do something else that you think is better. This is strategy hopping. Again, this is based purely on hope. I hope that this other strategy performs better than my current strategy. It's the only reason to change a strategy. Now, there's a big difference between moving between defined strategies that you know favor different conditions. Prime example, when we go through the tariff sell-off, at that point, I changed a bunch of the strategies that I was running. It was managing the long deltas so that I don't get ran over during the down move. And then it's adding a bunch of short deltas, a different strategy, to then take advantage of the subsequent downside move. The big difference there is that's all part of a plan. It's all part of a playbook. It's not me seeing somebody else trade another strategy and I say to myself, oh shit, I wonder if that one will work better than what I'm doing. Again, going back to the lottery ticket scratch off example, let's add a piece onto that. Let's say you have that specific combination of lottery tickets that you're supposed to scratch off. And if you do, you are guaranteed to make money. Or you could deviate. If you deviate, you might not make money, or you could make even more money. Would you deviate? There's no right answer to that. And part of it is an expected value calculation. How much could I potentially make if I deviate versus how much am I guaranteed to make? But let's make the scenario simple. Let's say that you're guaranteed to make 10 grand, but if you deviate, you might make 12 grand, or you might make nothing. Would you deviate? No. That's a terrible expected value calculation to jump from. There's no way. There's no way that you would give up a guaranteed 10 grand for a maybe 12 grand. It's the same thing with strategy hopping. If you think about what causes people to strategy hop, it's that exact issue of thinking that there's something else that might work better. Once you go through the effort of building robust strategies that you trust, that you have confidence in because you've earned it over the application of the skill set and seeing the outcome, you're not really inclined to strategy hop. Because again, you know that if you follow that specific configuration, you kind of know what you're going to walk out with. The strategy hopping example, you have no idea what you're going to walk out with. So it becomes that lottery ticket example, guaranteed 10 versus a maybe 12. Take the guaranteed 10. That's what I would do. We already hit this one ad nauseum. No reason to hit this again. This one, I still hold true, even for a lot of people in our community. My guess is a lot of people in our community still don't have a trade log. And I think it's for a host of different reasons. I do my best to address this in as many ways as I possibly can. But the reality is, even in our community, I don't think that there is an absolute ton of people with developed trade logs. More importantly, if I think outside of our community, I would easily wager the overwhelming majority of traders do not have a trade log. This is about as unprofessional as you could possibly be as a trader. Like, if you are taking this even marginally serious, it's about as unprofessional as you could behave. An example I give for this is, imagine that you have an online store, e-commerce, and your online store sells pens and mouses. This is what you sell. At the end of the year, when you're doing your taxes, your accountant or whoever does your books is going to say, hey, give me your financials for the year. And what you're not going to say is, oh, yeah, I remember in January, the pens did really well compared to the mice. And then it was super weird. In February, the mice came back with a vengeance. So I think they did maybe 1.5 to 2 times the pens. But then March came around, and that's the month that Eric was born. And I think there was like a lunar eclipse. So the mice just crushed it that month, right? Your accountant is going to look at you and say, what the fuck are you talking about? Give me the financials, you idiot. Yet, traders do that exact thing. If I were to ask something like, hey, what strategy is working well in the current market regime? Most people can't answer that. It's crazy. But it's the same exact thing that I just gave you. Because going back to the example of mice and pens, let's say for 2 months straight, I noticed that my revenue is dropping as a business precipitously. It's getting to the point where I'm going to have to start cutting staff members, things that's pretty dramatic. Well, one of the first things I'm going to do is say, well, what's dropping and why? Is it the pens or is it the mice? Are they both dropping terribly? Can't say what is objectively working in this current regime, what is not working in this regime. How do I move the money from what's not working into what's working? There's no objective way to do that. The entire purpose of a trade log is the trader version of bookkeeping for a business. That's all it is. This isn't some sort of magic secret thing. This is base fucking practice for being a professional. That's it. Next, theta. I always mention this one because the short option premium sellers always get pissed off at this one because they are convinced that theta is an edge. And I will always remind them that it, in fact, is not. And more important than that, their perception of theta as an edge highlights a really dangerous fundamental misunderstanding of derivatives. Period. If you think theta is your edge, then you optimize for theta, when in reality, that isn't actually what's going to produce the profit that you think you want to see. It's the reality of it. Theta is just the way that we compensate for convexity, for gamma. It's the trade-off. There has to be a trade-off. You can't get free convexity, period. And if you sell options, you're stepping in front of convexity. You should get something for that. It's just something that balances the scale. The edge that most premium sellers are actually attacking unknowingly is not theta, but it's volatility. It's stuff like variance risk premiums. It's stuff like put skew. It's stuff like kinks in the volatility surface when they're doing stuff like calendars, not theta. Theta is just a piece of the trade. But that leads a lot of people down the entire wrong path. You think buying or selling is better than the other. I make a point when I talk to Tom Sosnoff from Tasty Trade. I have him on the podcast. I've asked him a few times about this because I know what the answer is. And I'm actually curious how ingrained he is in his approach in marketing and stuff like that. And was he going to give me a genuine answer, or was he going to give me just something to support his position? And the few times that I've asked him this, he's always given me the correct answer. And the correct answer is objectively, one is not better than the other. You can have a preference. Your preference is cool. Have a preference. No problem with having a preference. But having a preference is very different than one being structurally better than the other. It's not. Buying, selling, same. Slightly different way that they do things, but overall, you're attacking the same stuff in a slightly different way. Next, super common. People think a high win rate means they have a strategy that's doing well. This is actually one of the absolute most important things you can do if you're ever looking at some sort of like trading service or alert service, anything like that. And if you look at those and you see them tout a high win rate, but no expected return, you know that those people have no idea what they're doing. Straight up. They have absolutely no idea what they're doing. And it's because they think that the win rate looks good. Big win rate. Great. Love that. What's the problem with a high win rate? You can still lose money. I've given you guys tons and tons of examples of this. And it's not that difficult to think of your own. If you have 10 trades and on 9 of them, you made $10. So you made $90. If on trade number 10, you lose 100, you have a 90% win rate, 10% loss rate, yet negative expected value. That's not that dramatic of an example, by the way. This is commonly focused on, and it's completely wrong. It's the entire wrong spot to focus your attention. Leading into the term expected return, which is what I was referring to in the last line item. Win rate by itself is relatively useless. Win rate as an input to an expected value or an expected return calculation is very useful. That's the difference. You use it as an input to a more important equation as compared to just its own thing. This one I've talked about a little bit just because it's becoming more popular, I notice, which is this whole thing of GEX, DEX, dealer positioning, what the charm is, what the Vanna is. And it's kind of crazy to be honest, because people think that there's some sort of like magic information in this gamma exposure plot. Like, oh shit, if SPX gets to the 6600, there's going to be fireworks because the net gamma is slightly negative. The problem with these tools, one, is they make a broken assumption to start, which is that dealers are on the other side of every single trade, and they're not. The other issue and the bigger issue that these plots have is it completely forsakes what the rest of the book looks like. A lot of times, dealers will have individual components. So if we're looking at SPX, that means that they'll have a bunch of individual stocks from S&P, long sum, short sum, complete mix. Then they might use SPX as part of their book to hedge some of it. I think the thing that people forget is that market makers don't just have to blindly take everybody's orders all the time. They're really smart the way that they do things. It's how they stay in business. For example, if we're looking at something like this, grab my handy dandy pen. This is a good spot. Let's say the dealer has a basket of stuff. Individual stocks from S&P. Let's say that this basket is net short. Then let's say to offset some of this, they can either hedge directly in the individual names, or they can hedge it as a basket. And instead of going into a bunch of individual names, you just go into SPX. Again, this is a very crude example, but it illustrates the point. In here, they choose to go net long. Here's the issue. Sometimes, depending on what their book looks like, if price starts falling, they might actually sell into it and amplify it. Completely separate from this thing that's telling you that when stuff gets there and they're net short gamma, that they should be buying gamma to counteract it. Why? Because maybe this stuff has now started accelerating in the way that they prefer, and they're trying to lean into the move. There's nothing that says that they have to remain perfectly delta neutral. They don't. They lean all the time. The other thing is they adjust their risk based on what they offer you. Let's say in SPX, they're making a market, and let's say that they're at size. They don't really want to take a bunch more risk, but they have to make a market. There's specific rules on the frequency that they have to maintain quotes. There are not rules on what the quotes look like, what the size is. Let's say that originally, when they were building this net long position that they wanted to lean into, they were offering at, I'm just going to use round numbers because it's easier. They were offering at, or buying at 550, and they were offering at 6. Remember, at the bid-ask spread, this is your bid, this is your ask. Within the bid-ask spread, there's another really important element that people don't take into account: the size. They can decide how many they're willing to buy at 550, how many they're willing to sell at 6. In this case, if they want to get more long, and let's say that these are calls, what they'll do is they'll say, okay, here, I'll take 1,000. I don't actually want to add net short, so I don't really want to sell these calls. I'll give you 10 of those. I'm making a market. These are good bids. These are good quotes that are live, but I'm going to adjust the risk that I take on by giving you different size and using this size differential to manage what ends up building out to their book. This forsakes literally all of that, all of it. And it's simply assuming in a vacuum that these are the positions. All of that said doesn't mean that this is useless, because it's not inherently useless. It can still identify areas that there could be interesting price behavior if they are leaning a little too far one way or another. The more important point, though, is that it's not predictive. Just as support immediately becomes resistance and vice versa, it's the same thing here. It could be something, but more often than not, it's not. And it's not very predictive. And again, that's just something that you have to be privy to if you're going to use tools like this. We'll do a couple more, and then I will open it up to any questions or anything that you guys want to look at for 5-10 minutes. You say things like, when I use Bollinger Bands, they typically work pretty well. Here's the issue. You already know this. Your memory is fallible. Your recollection is fallible. Your internal data analysis is fallible. We have a natural tendency to want to be correct. Our ego prefers that. It doesn't want to face being wrong, so it will interpret things favorably very often. The problem here is that your recollection means, quite literally, nothing. You cannot make any logical decisions based on your recollection. The only thing that matters when you're testing, for example, here, a signal or some sort of indicator like Bollinger Bands, is actually tracking. It's using Bollinger Bands to make decisions and then tracking not only when you make the decisions, but what's the outcome of the decision that you made. Did it resolve in your favor or against your favor? Period. You have to go through that process. It's the only way to actually know. But again, most people will just say things like, oh, I use Fibonacci's all the time, and it's crazy how price always behaves against Fibonacci's. It doesn't mean anything. Okay. This is an issue where people take a constraint and then they think that literally anybody cares about their constraint at all. Nobody cares about your constraints. That doesn't mean that you don't care, and that doesn't mean that you don't have to plan around them. You absolutely do. But your constraints are your constraint. So for example, if we're trying to build a strategy and somebody says, I don't know how to backtest, that doesn't mean that you get to not backtest. It means that you now have another task to accomplish. You need to learn how to backtest. Just because it's inconvenient, just because it's something that you don't know how to do, doesn't mean that you just don't do it. It's not a choice. That's not going to work. And there's different ways to teach yourself. There's different ways to backtest. You can find things that meet or work with your constraints. But it's important to remember that your constraints are literally just your constraints. They are headwinds. They're not things that help you. For example, when I was on active duty, I worked on a part of base called Camp Horno on Camp Pendleton, which is really, really difficult to get any sort of cell reception. It's kind of like in the middle of Pendleton on the east side of the mountains. There's not good cell reception there. What that means is during the day, while the market was open, I couldn't trade. So that's my constraint. That's not some sort of positive attribute. That doesn't help me. It hurts me. But I have to find a way to work around it. How do I adapt? By doing stuff like this. Most of my work done for trading is done when the market is closed. And that's because I've built a methodology that supports that, because that was my reality for a long time. I can only do the research when market was closed. That's also why I've adopted approaches that don't rely on me sitting in front of the screen all day. It's also part of my longer term imperative, because the whole point of me getting into trading, hopefully, was to make a bunch of money and to unlock my freedom, not chain myself to a desk and simply have a different master. That all said, there's a big difference between what your constraints are and then again, what is optimal. And in this kind of scenario, you just have to acknowledge what your constraints are and you have to find a way to work around them. Another really, really common one is data availability. People will say things like, oh, I don't want to pay for data to be able to backtest. Who fucking cares if you want to pay or not? I would much prefer to not pay either. I would also love to be better looking. But guess what? I'm fucking not. It is what it is. But that doesn't mean that I just don't do it. It might mean that I try to do it as thrifty as I can. Maybe I meet with 10 other traders and we pool our money together so that we can get a subscription to something that provides data, and we can share the API tokens so that we can get what we need, and then we can crowdsource it, right? Like, you can find ways to navigate around those kinds of constraints. But just because you don't want to pay for data, again, literally doesn't mean anything. It's not free. Same thing where if I'm running a business. If I'm running a business and I'm trying to figure out if I should sell pens or if I should sell mice, what are the ways that I can figure out which one of these I should sell? Maybe I think about doing some sort of survey. So I contact a survey provider, people that know how to administer effective surveys to my target audience. And do they do that for free? Fuck no. They have a business around it because it's a service that they're providing to you for valuable information that you then in turn use to make money off of. It's the same exact thing in trading. Access to things like backtesting, to information, those are table stakes. Again, if you're going to take this seriously, you don't have to. You could take trading at a less serious tone. But again, your performance is absolutely going to reflect that, and you have to accept that. You might say to yourself, the process of backtesting is too long for me to learn how to do that. I'm better off redirecting that effort into trying to get a raise at my current job and doing something simpler in the markets. That's completely fine. There's an opportunity cost. What's the opportunity cost? It's that percent. It's that 2%, that 3%, 5%, who knows? But there's an opportunity cost associated with that decision making. Again, entirely up to you what the correct decision is. But the point there is that you have to objectively make the decision. And it can't be you saying, well, this will work best because I don't want to buy data. That doesn't mean it's going to be best. It just means that it's what you're choosing to do, which again is fine. But you have to think through things. Trading is absolutely hilarious because it deceives a lot of people. The barrier to entry is super low, easy to do, but the stuff that you have to do in order to make this work long-term with any degree of confidence is not magic. That's the beautiful part about it. The fact that it does take effort and you to do some basic things is a beautiful thing. It is what leads to the opportunity being there. So I actually think people should be very thankful. The fact that it doesn't just automatically happen. It's not something that you don't need the data to perform well. If it was, then the edge gets shrunk down time and time again until there really isn't much left. But right now, there are still droves of people that will continue to take the haphazard approach to this which is exactly where the opportunity for people like us have, is to pick up that slack. Let them be lazy. Let them do the simple stuff. That's cool. And I still hope for those people that they find a way to make it work. There's no part of me that doesn't want other people to succeed in this, because it's highly possible for literally everybody, because there's enough people that won't. The edge is there. The opportunity is there. The money is there. But it's up to you if you want to go get it, which you all know. I believe the answer is go get it, because you make a lot of money doing this, which is pretty cool. All right. That sums up my TED Talk. Let me see if there's anything that you want to talk about, or if there's any questions on anything that we went over. You can throw that in the chat. The other thing that I want to direct your attention to super fast is the first one is I have a new podcast out with another channel that I was on that was pretty cool. So this is that podcast, if you want to check that out. And then I also have recently started a new podcast mini series on my podcast with our very own community member, Shrey J. And it's really designed to explore ideas a little more rigorously in detail. And I'm looking forward to it. The first episode was fun. Definitely looking forward to your guys' feedback on what you would like to see in subsequent episodes. And then the third thing is the next Zoom workshop for the Outlier Pro Plus members is Monday, the 20th at 5 p.m. Pacific time. There's still the discount code available. We have a few seats left. So if you would like to join up, let me know. I have a discount code for you, give you some money off to come hang out, check it out, see if you like it. It's super fun. Like I genuinely look forward to them. It's always cool to like meet with traders live, have actual conversations, and progress. So Lauren says it was really good. That's awesome. That's honestly really, really cool feedback. I think Shrey did a good job. And I think especially with where Shrey is, he really is such a great middle ground for us. So I'm like super, super stoked on that, because he knows the way I think and the way that I do things, which is rad. And he can help me connect the dots for where people might be struggling, or stuff that people might not even know they should ask, stuff like that. So yeah, I'm really looking forward to it. If you guys have any recommendations, suggestions, anything like that, any topics that you want to see us kind of go back and forth in that manner, just tag Shrey J in the Discord and he'll earmark it for us. The way that we're going to do it is we'll have like a little time at the end for each one for kind of like a rapid fire Q&A. And then we will, spend time just talking about stuff like we did before. But I genuinely think it'll be like super useful. At least I hope it is, but I think it will be good. Most of the stuff that I make for you guys really is, I literally just think like, is this something I would have liked? And that's literally it. So maybe it's selfish, but I just think it's a good way for me to at least think about the stuff that genuinely is useful and adds value. So I'm glad that it was good. Sweet. All right, gang. That wraps me up. If you guys need anything, you can hit me up in the Discord, be an outlier. See y'all later.